Hello, hello. Good evening. Hope you guys are well. Had a great week. So let's get started. We got a bunch of stuff here to talk about today. Every day is like packed. All right. We got a lot of stuff. So let's get started. Okay, today we're gonna talk about the prediction that large banks have been making about the next decade for the U.S. stock market. And it's not very exciting. Let's talk about it. All right, what we can do if this scenario that Wall Street is expecting, if it happens, what can you do? All right, especially you that all of us that we want to accelerate our journey to financial freedom or to um, our retirement or any other financial goal that you have. You want to accelerate your journey, but with a gloomy prediction like this, what can you do, right? Are you gonna give up on your dreams, or just because the market is such and such, right? Is there something that we can do? I believe there's a lot that we can do. All right, we can avoid this scenario, the worst scenario from materializing, even if it happens. Okay, so just a quick update of the and here actually here is the reason why I believe we can do a lot better. Okay, so these are the 8 strategies. From since 2022, we've been publishing the results on a daily basis. We already had like 3 years. Most of the strategies outperforming the S&P 500. This year, in 2025, uh, we are already. This is as of today, the closing of today, right? Especially strategies 6 and 7. We're going to talk a little bit more detail about those. These two, okay, they have been phenomenal the last few years, always on the top. Um, they use 3 levels of risk. We're going to discuss this a little bit more detail. And the other strategies from 1 to 5, they are like two levels of risk. Okay, we got more granular on the 3 levels. We have 3 assets rotating. Okay, and this is a tactical, dynamical, strategy. It's not like it's not buy and hold where you never do anything. You just sit on your position, and this is not also. It's also not day trading. Not day trading at all. Okay, the frequency of trades, it's on average like 2 trades a month, 2 to 3 trades a month. Okay, it really depends on the market. If the market is very volatile, it's possible that you will need to trade a little bit more, but still this is ideal for someone who is a busy person, not a trader at all, someone just want to invest, and also they want great results, they want to accelerate their wealth. So that's the idea. In 5 years, we're already over, strategy 7 based on NASDAQ is already over 300%. Okay, the strategy 6 based on the S&P 500 is 265%. All right. Anyway, what's the most important thing to note is that even though they're beating the S&P 500 by a lot, in the last 3.5 years, the important thing is that the maximum drawdowns of those strategies are not greater than the S&P 500 itself. Look at this one, 22, right? Maximum drawdown. The S&P 500 is returning much less with a larger, almost the same, I'll say, almost the same kind of drawdowns. All right. So, because people always tell you that, you for more return, you need to take more risk. Well, if you follow our strategies here, the rotation, between the assets based on risk management, you'll be able to not increase your risk, but boost your return by many, many times, like almost 10 times. All right. We're going to talk about this today. All right. So today, we're going to discuss this topic just to reiterate our mission statements. Our mission statement is to empower investors to accelerate wealth growth through education by maximizing the return to risk ratio. Again, return to risk ratio, not just saying returns, right? Return to risk ratio, and outperforming the S&P 500 every year as a consequence, as a result. All right, because we're doing this. Okay, perfect. Okay, so I just brought up, it's because this is all over news. I just brought up this one here for us to examine line by line. Okay, what's happening, right? What the analysts are talking about, right? So these two are from the same person, who wrote on USA Today, and the first one, they're just like a month, yeah, 2 months apart, I'll say, yeah, so 1 to 2 months apart, um, about that prediction, right? So the first one, it says, stocks usually rise by 10% a year. I think that's the S&P 500 average return. Those days may be over. And the second one is, forecasts predict that this moment decade for stocks, here's what to do. We're going to look at what they suggest you do and contrast with how we do it. All right. And we're going to show you how the way we do is much better, of course. Okay. So, all right. So it says, over the past several decades, the US stock market has yielded average annual returns of around 10%. But those days are over, right? What if those days are over? So let's talk about this one here. Okay, so let's focus on this paragraph. In recent forecasts, Vanguard projects the stock market will rise by only 3.3% to 5.3% a year over the next decade, over the next 10 years, from 2025 to 2035, basically. Morningstar sees US stocks gaining 5.2% a year, which is half of the average return in the past 10 to 20 years. Okay. Goldman Sachs forecasts the broad S&P 500 index will gain only 3% a year. Wow. Goldman is even m- less upbeat than Vanguard. All right. Okay. And let's take a look at this paragraph now. Those numbers aren't outliers. A roundup of market prognostications. Oh, sorry, how to pronounce it, this word. The people who make the prognoses, right? Charted by Morningstar, finds no one projecting annual returns higher than 6.7% for the domestic stock market in the next 10 years. Wow. They're really not very upbeat about the future for our domestic stock market. This prediction came even before Trump. All right. So it's not because of the tariffs or anything. They're going to talk about this in a minute. We're going to see it. All right. Perfect. So stocks are having an off year. What can I do? Right. Um, so let's move on to the practical question. If the S&P 500 might not gain much ground in 2025, what should ordinary investors do about it, right? The easy answer, of course, is do nothing. Wow, do nothing. Is this a good thing to do? Just to do nothing, just to be sitting and whatever is going to be the fate, I accept my fate, right? Is that the best thing you can do? Anyway, let's keep moving, right? Oops, sorry about that. Whoops, a little screwy over here. Okay. Oh, no, that's not what I wanted to move. I want to move this one. All right. So, stock market projections for next month or next year shouldn't matter much to a investor who is in for the long haul, advisors say. Right? So you don't have to do anything because you're here for the long run, right? So just just sit back and relax, just enjoy the ride, right? While you lose money, well, yeah, okay, it's not their money anyway, right? So, who cares, right? Okay. And that advice applies to just about everyone. If you aren't in for the long run, expert advice, stocks might not be for you. Wow. So you now you have a choice, right? If you just you don't like just sitting around doing nothing, another thing you could do is just forget about stocks. Oh my goodness. Wow. These people are so defeatist. My goodness. Anyway, um, and they keep going here. If you need funds soon, don't have it invested. A certified financial planner said, if you don't need the fund for 15 years, stop looking at the volatility. Wow, yeah, really the advocate for doing nothing, right? Just sit back, don't even look at what, if you're making money or losing money, who cares, right? Just don't look at it. If you don't look at it, you pretend there's nothing's going on. That's fine, right? You just go about your day. Nothing's going to happen. My goodness. Oh, this one is a killer. Market downturns tend to be brief. Recessions are shorter than they seem. Anyone who is saving for retirement or for other long term goals can generally ride them out. Oh my goodness, they want to kill me, right? Wow, terrible. How could someone just say it? Just go back to the history and you'll see that market downturns, of course, they're three types of market downturns. The first is a pullback. Pullback goes up to 5% down, right? Pullbacks is fine, because maybe in a couple of days or in a matter of weeks, you'll recover. And then the second type is a correction. A market correction is usually up to 10%, 10 to 20%, right? That, in that neighborhood, right? A correction, it may take weeks and months to to recover. And then you have the crashes, which usually is referred to those downturns greater than 20%, 20, 30, 40 or more. And we've seen those. And those you may need um, years, if not decades, to get your money back. So don't come to me and say, well, recessions are shorter than they seem. So someone who's saving for retirement or long term goals, just, don't worry about them. My goodness. We're going to show a little bit about this history in a minute. Okay. If you have the luxury to be a long term investor, be one. There is, however, a longer and more nuanced answer to the question of how to respond to those conservative projections for stocks in 2025. Incredible. But let's keep going. All right. So let's take a look at what really happens, right? So this is the stock market since the 1930s. This is the cycles of this S&P 500 index, right? So we have positive ones and negative ones. Okay, how long do they take, right? Because the US stock market, from a historical perspective, has been, a bullish market, a very long bullish market. So it's natural to expect that we'll have more periods of bull markets than bear markets, right? However, when you have a bear market, it happens in every few years, right? It seems like every decade you have at least one or two. The big ones. I'm not talking about the small corrections, smaller corrections, etc., but the crash, right? Look at this. How long did this one take? This was, of course, this is the 1929 crash, right? The market went up 324%, but when it went down 60%, it took 5 years, right? I just remember the guy said, the brief period, right? Brief? Not so much. Okay. This one took 3 years. This one took one and a half, 1.2 years. This one was fast. 0.5, 0.7, 1.5, 1.7, 1.7, 0.3, 0.2, 2.5, 1.5. This one was the COVID, the coronavirus crash. It was really, really fast. Just a matter of months, not even months, a matter of weeks, the market recovered really fast. Okay. And then go so on and so forth. All right. So, so you need to avoid these things, because it's not only that your money is going to be recovered, because you have a huge lost opportunity cost, because while your money is stuck in a losing position, and you don't want to realize the loss. You say, hey, I'm just holding it, the market's going to come back, I'm going to recover the money. While you do that, imagine if you had sold your position, even if at small loss or something, and then you take that money and invest it in something else during that period, which could even be stocks at a lower price, right? It could even be stocks, or maybe some other asset. During that time period, you would end up much, much better than just be holding on a, in a long, in a losing position for such a long period of time, especially when you don't know. So let's say you are here, right? You are already waited for 1.5 years, and you don't know what if the market will take it longer, right? You just keep waiting without knowing what to do. You have zero control of your life, right? That's how so many people have trouble arriving at their retirement age with the amount of money that they need for a comfortable retirement. Why? Because they follow this stupid advice. I'm sorry, I don't want to offend anyone, but it's a stupid advice. Okay. Okay. Let's take a look at this one. This was the anatomy of a crash. This was the 2008 financial crisis. Okay. So what happens here, right? There's a lot of people talking, wow, the best way to make money in the market is to buy the dip, right? Buy low, sell high, right? So people buy the dip all the time without really knowing what's going on, right? So this is the problem. Because if you think about it, how come so many people lost so much money with this crash if the crash didn't happen overnight? You see, the descent didn't happen very fast, like COVID crash, for example. It happened really fast in a matter of days. In 2008, it's not a matter of days. Look, several months, almost a year, right? Since early 2007, it already going down. But how it's possible that so many people were affected in their 401ks or any retirement account or any kind of investment this much? Would, would it be because of wishful thinking, that you're here, say, hey, now it's going to recover, now it's going to go back, right? Based on what? If you are based on what the news said, people talk on the news, like just the articles that we just read, right? They're gonna, no, don't worry, just hold on, just hold on, don't do anything, just hold it and it's fine, right? Just sit back and relax, right? Some people do that. Some people just buy the dips all the time. The buy the dips only work if the market is up in a bull market, your market's going up. So someone who's been buying the dip this time, they lost big time, right? They lost a lot of money. Okay, so that's why people get into trouble by following simplistic rules of thumb. All right, so they will get into trouble. All right, because it's incredible. This didn't happen overnight. It had taken a very long time. So why people didn't get out of this position, holding a losing position? Why? You want to make a point? Sometimes when we're caught wrong footed, what you should do, just, assume, okay, yes, I made a mistake. Everybody makes mistakes. Everyone makes mistakes. We made a mistake. Great. Fine. No problem. We take the loss here. No problem. All right. Because there's always going to be another opportunity in the market, right? Like a warrior can always fight another day. Don't try to, rescue a defeat, right? Losing, okay. Recognize it. It's a loss. No problem. Let's work a new trade, a new a new tomorrow. Okay, new tomorrow. Don't get, tangled into this thing. Doesn't It's not worth it, because time is money. The For the longer you are held prisoner in a situation like this, the worse for you, because your money is not working for you. Okay, all right. Enough of that. All right. So I'm just going to give an example of a stock, a single stock, right? Why I chose this one? It's because I was in a forum, and there was a bunch of people saying, "Hey, this is the time to buy United Health, because the analyst rating is a buy. They It looks cheap, right? And the market just tanked, and I think it was because of some lawsuit or something. And people think, well, the fundamentals of the company is still great, so let's buy, right? The problem is, all every time people use valuation to as a yardstick to make decisions if you should buy or sell. I understand the logic, but the problem is that is very difficult to do that, because you know the concepts of valuation is overvalued or undervalued. It really depends on what you're comparing to, right? Comparing to the same stock in the past, or the stock in the future that you're projecting, or but the important thing is you can make all kinds of projections you want, right? You can think about the future, predict it's going to be wonderful, A, B, or C, but would the market need to agree with you? That's the point, right? If the market doesn't agree with you, if you have a fantastic projection, to be honest, it it's not worth anything, because the market is sovereign. The market's king. All right. So don't fight the market. I'm gonna show you what happened with in this case. All right. So this was the situation, right? The market went down. This stock for United Health, and someone on the forum said, "Buy, buy! It's time to buy it." They bought it here, but then you know a few days later, this was in May this year, right? Just in May, it went down more. And then the same people in the forum say, well, you know what? I'm going to buy more. So that's the buy the dip mentality. All right. Buy more. Great. So it's a buying opportunity. Right. So it really declined 50%. All right. And it stayed at this level. Okay. So it was near 600. Now it went to, in June, July, it went to 300. All right. And wasn't giving any signs that it's going to recover or what, right? Just flat. So at this point, how much does this stock need to grow just to recover the 600 level? 300 to 600? 100%. So your stock needs to climb 100% to neutralize the 50% decline. How likely is this, and how long you will have to wait for this to happen, right? Because you're stuck here, you don't know what's going to happen, right? No, I don't want to take a loss. No, 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 I want, let's wait. All right, okay, wait. How long? Okay, so this is in August. I just printed this 2 days ago. Look what happened. That was the 50% decline. Now is 60% decline, right? So now is 240, right? A few more, just let's see, a few more weeks, that was in June, right? June, July, August, right? A month or two. It's still on the way down. At this level, it's required 150% growth to get there. Again, how long will you have to wait? Okay? Because it hasn't even turned around yet, right? It's not like, oh, turned around, it's going to take a long time to climb. It hasn't even turned around. It's still going down. All right? Several months here. I don't know. I'll follow. Okay? At the end of the year, we're going to show this chart again. All right? Okay, so again, just to demystify that, right? I think I showed this charts before in other meetings, but just wanted to reemphasize, right? Because this is what happens, right? It's it's asymmetrical. If you are down 50%, you need 100% just to um, you know subsequent growth just to neutralize that 50%. 60%, you need 150%. That's what we just saw, right? And a lot of people think, well, I can hold it, no problem, because stocks always go up in the long run. Yeah, right. Yeah, it does. It seems like it does. But the problem is the time that you waste during these downturns, right? Are you being optimal with your money? Do you want to accelerate to your wealth to your desired destination? Could it be financial freedom or um, retirement or any other financial goal that you have, right? So think about it. All right. So sometimes if you're caught in a downturn like this, it's gonna take a long, long time, right? At some point, even the person who says, no, I'm not going to do it, is going to be for the long run. Huh. At some point during this run, you're going to pull the plug. I guarantee. Okay. Because we're humans, right? At some point after losing such a, I don't know, because even if we look at these guys here, they didn't say anything more on the forum, right? What they did now, because look at this, right? They're losing a lot of money. So maybe someone already, threw in the towel, right? It's possible, right? Because we're humans. Everyone has a tolerance for losses. At some point, we're gonna pull the plug. The I would say the earlier, the better. Okay, don't keep waiting. It's not a good strategy. This one is not the United States. This is the Nikkei. This is the Japanese stock market, right? Had a peak in the 90s, 1990s, right? It only recovered 40 years later, 40 years. All right. I don't want to be the guy that was sitting here in a position and holding until, anyway, doesn't make any sense, right? This one was the 2008, sorry, this was the 2000s internet, the dot com market crash, right? Went down almost 60%, needed 131% just to recover. It took 6 years. The Nasdaq during the same period here, the Nasdaq, this is the S&P, right? The Nasdaq took 15 years. All right, 15 years. All right. Of course, I said, wait, but this is at the extreme. I know this is extreme, but when you are investing, how do you know you didn't fall into one of those? So, for example, you are here, right? You are here and you're holding a position and it went down a little bit, 10%, 15%. You don't know, right? You don't know if this is going to develop into this or maybe it will just recover, right? Anything is possible. So you got to be prepared for any eventuality. You don't know. Maybe it will turn into something like this. So you got to be careful, okay? You have to consider that these things may be just soon. If you look at the news recently, there's a lot of people talking about, wow, there's gonna be a crash. The U.S. dollar is going down. The interest rates in the U.S. is going up like crazy. You know, um, the the treasury market, the treasury bonds are not finding um, buyers, especially central banks, as it used to, and it's going to be a huge crash. I don't know if this is going to happen or not. I don't know, right? I don't know. I don't make predictions, and I think you shouldn't make predictions too, because most likely our predictions are going to be wrong anyway, right? There's no crystal ball. What we do is we look at the present, and we focus on risk management. I think that's the best way to deal with situations like this. All right, so we can be nimble and change our positions quickly. All right, that's tactical investing. All right. Okay, so if you look at most funds, this is kind of shocking to me. All right, most funds um, in the US, you have large cap funds, mid cap funds, small cap funds, multi cap funds, all kind of funds that you can imagine. Growth funds, core funds, value funds, mid cap, small cap, every kind of you can imagine. And they will use as a benchmark, comparison index, a benchmark, usually some S&P 500, S&P mid cap 400, whatever, right? Any of those S&P indexes as a benchmark. Look at this. In the first year, let's just take a look at this, the first line here, that all domestic funds, the S&P composite, I'm sorry, they have the S&P composite 1500 as at the benchmark, right? So the first year, 50% of all the funds underperform the benchmark. So 50%, 50-50, right? 50% over um, um, outperform, and 50% underperform. Okay, I'm sorry, in 3 years, 78% underperform. 5 years, 86%. 10 years, 93%. 15 years, 93 and 95, and a 20-year period, 92% of all the funds, all the domestic funds, can't beat the S&P 500. Okay, so actually this one is the composite. The second one here, the all large cap funds compare with the S&P 500, right? 94% of in a 20-year period can't beat it. Okay, so that's why in a short period of time, and if you like, so for example, in a month or 2 months or a year, wow, I beat the S&P 500 or any other of those benchmarks here. Oh, great, fantastic, feel great, right? Can you do this consistently? Consistency is the key. Okay. Of course, you may have a year that is not great, but can you do better than the S&P 500, right? Or any of these indexes? As we can see, the vast majority, the overwhelming majority, can't do it. All right. Okay. Okay, let's compare to our results. Of course, my history here is not that long. It starts in 2022, right? But so far, every year we have been doing pretty good. Okay. So how can we do this? How could we do this, right? So again, this is the risk 500 indicator. It is a risk management indicator. It measures risk, and every time the risk that's measured goes above this red line here, see this red line, that's the 75th percentile. It's my personal risk tolerance. For someone who is more tolerant to risk, this line can be a little higher. For someone who's more conservative, this line can be a little lower. But every time the indicator crosses my tolerance level, all right, if it's higher, I will sell my position. If it's lower, when it's going lower, I'm going to buy back. All right. So that creates a market timing kind of thing. The idea behind this, before we started to, when we created this, was not for market timing. We just wanted to have a early detector of market crashes so we can avoid it. That was the original idea. Okay, but then we realized that, hey, look, it works like a market timing device pretty well. Okay. And also, we concluded that it's maximizing return over risk ratio. All right. So here you can see 2022 was a bear market, right? So we had to trade a little bit more. As you can see, this is months, right? So we're not trading every day. Okay. We're not trading every day. Okay. And in 2023, we had a pretty good run here. And 2024, we also had a pretty good run, even higher slope here, right? So it was growing really nicely. And one of the things I think is it makes most people who use the indicator um, tell us, hey, it's helping us, is because of this. Because market is not never a straight line, right? You have the zigzags, the ups and downs. How do you know which downs are dangerous or not, right? So here, for several months, from April to October, pretty much from April to October, several months here, you got very low readings of the risk indicator. That means that all these oscillations here, fluctuations of the market, are not dangerous. Okay. So, and also, of course, compared to my own personal or yours or any investors risk tolerance level. Okay. That's how we did it. So, during that period, 2022, this study goes up only to last year, June 2024. But as we can see, there were like seven major periods where we had to seek safety. All right. Yeah, we seek safety. So by seeking safety, the act of seeking safety itself was a booster for our P&L. Okay, just money that we avoided losing helped us boost our P&L and improved the return risk ratio for us. I'm going to show you guys in a moment. So this one here is strategy one. Strategy one is the simplest one, right? So it's basically you are rotating between uh, the S&P 500 ETF is SPY and cash, right? So when we have low risk, we're holding the S&P 500. When it turns high risk, we just switch to cash. That's all we are doing. All right. So look at this chart over here, right? So this, let's say you started with $1,000 on January 1st, 2022. Okay, $1,000. If you invested in the S&P 500, you buy and hold the S&P 500, this would be your path. The blue line would be your path. All right. So it would end up the year, right? 2022. That was a bear market, right? With 19.48. So it's a 19.5% down, negative 19.5%. But the if you have done the strategy one, uh, every time that the risk 500 went above your tolerance level and you switch to cash, you rotated to cash, look what happened. You see those plateaus, this plateau, this little plateau. Those plateaus refer to the major dips that happen with the green line that were just avoided because we switched to cash, right? So we were holding cash here. So we avoided going down and making this trip here, right? Okay, we didn't fall into this holes. Basically, that's it. So what happened was that year end, we ended with plus 0.53. So almost nothing, right? We still had like $1,000. We still had our $1,000. Whereas if we're just buying and holding, we bought and held the S&P 500, we would be down almost 20%. Okay, we avoided that. All right, then starts 2023. 2023 was a bull market. So you see, both went up, but look at this. We didn't need to really do much. Just we're here pretty much buying and holding as well, right? Just buying and we held all the way up pretty much, right? There's a few periods that we had to rotate to cash, but most of the time we're just holding it, right? So that's why those two lines seem parallel in 2023, right? Look here, in September, the buy and hold investor finally, right? Almost 2 years, 1 year and 9 months just to break even. That's time that he just threw away in the garbage can, right? Time wasted, right? Okay. Whereas this guy here who was investing with strategy one is already up here. Okay. Already up here. So that's the logic. All right. So if you look at this second chart here about the drawdowns, you can see. Look at this. These are the drawdowns of the S&P 500, the blue line, and the orange line is strategy drawdowns of strategy one. Look that the orange line is well is the drawdowns is much smaller, right? The greatest, the highest is perhaps like -7, whereas the S&P 500 went all the way down to -25, 26, right? Okay, so this is risk management. You are making money. You're creating conditions for you to um, realize a higher return just by doing risk management, not just buying and holding. Like, oh, okay, no matter if it's raining or it's shining, doesn't matter. Just sit back and relax. Well, you do that, you lose money. Okay. So, all right. What about strategy six, right? Strategy six is strategy one on steroids. So, strategy six, we have like three levels of risk instead of two levels of risk. We have three levels of risk. We have low, medium, and high. All right. We have two RPTs. We have, you know, instead of just one cutoff level, right? Like your risk tolerance level, here we have two of them. Okay. So, um, every time the risk 500 crosses RPT2, we're gonna rotate from this S&P 500 to gold, right? And when it goes below the RPT1, we're gonna rotate to the SSO, which is a leveraged twice the S&P 500. So every time the S&P 500 goes up by 1%, the SSO will go up by 2%. The problem is that when the S&P 500 goes down by 1%, the SSO will go down by 2% as well. So that's a double-edged sword. It can help you and can hurt you big time, right? So, but if you don't have a risk indicator like the risk 500 guiding you, it's very, very risky because you don't know when you're holding at the SSO, you can get killed, right? But when you do have that in a low risk scenario, we're going to hold this to speed up the our return. Okay. So let's see what happened with strategy six. We saw strategy one here, right? How about strategy six? Well, the S&P 500 here is still like about 20% down, right? Look at this. Strategy six ended 2022 with 33% up at year end. Okay, remember that 2022 was a bear market. Was a bear market. Okay, how could we make 30% on a bear market, right? By tactically rotating positions according to risk management. Look at this. This one here, strategy one is simpler, right? It's cash or S&P 500. It couldn't do much really. At least it just preserved value. That's pretty much what they did. They didn't really make much money for us. Just preserved against losses. We didn't lose, right? Whereas if you're buy and hold, investor. You lost money here, you didn't lose anything, but here you even made money because you had the system, a more granular use for the risk 500. Okay, let's look at the drawdowns. The drawdowns, well, look, even though we are using the SSO, which is a riskier asset in some periods of time, we still had lower drawdowns than the SP 500. Okay, and gave us a much better return on our money. Okay. All right. So the idea, what's the idea? What's the idea for strategy 6? It's like you're running on you're driving on a highway, and you have different types of pavement, right? You have bad pavement, good pavement, and autobahn quality pavement, right? So if you encounter bad pavement, you have to slow down, right? You can't drive the same speed, right? So the analogy to the markets is that the buy and hold person will drive at a constant speed regardless of the pavement, right? So it will, when it hits a bad pavement with this holes on the way, what happens is the car is going to be sent to the mechanic, right? You're going to change the struts. You got to change, the suspension, the the springs. All gonna, so your car is gonna be in the mechanic for a long time, and that time is the lost time in the markets. That's pretty much the analogy, right? So when you are in at low risk in the market, you can afford to speed up. You can, hit the pedal to the metal, right? And speed up there, right? So that's the investment in SSO. I'm going to show you guys exactly how this works. So the travel road analogy is this, right? So you have bad pavement, you slow down, you go, it's lower than 20 kilometers. I'm using kilometers per hour because we have audience outside the United States as well, but it could be miles. Doesn't matter. Okay. On good pavement, you're running at normal speed, and if you have a great, you're on autobahn, you can just like hit the pedal, right? Hit the pedal. Okay, so the analogy is the bad pavement is when you encounter high risk in the market. If the risk is high, you gotta seek safety. You can't be holding risky assets in a moment of high risk. Okay, that's the problem, right? You need to deleverage. You need to go seek safety. So safety assets like could be T-bill, could be cash, could be gold, could be some asset that will preserve the value of your money, right? And not be exposed to risk. Okay, when you're in a moderate risk situation, you can hold stocks, you can hold the SPY or the QQQ, right, the Nasdaq. But when the risk is low, hey, now here you can be bolder, right? You can invest in a riskier assets like the SSO or the QLD, which is double the Nasdaq, right? You are hitting the road with twice the speed. Okay, so if you do something like this, this is exactly strategy 6. Strategy 7 is the same idea, but just instead of the S&P 500, it's Nasdaq. Okay, which usually even is Nasdaq is more volatile. Okay, it can give you a larger return. All right. Okay, so again, just to summarize this, why we can get this kind of returns. All right. Okay, let's just continue what they're talking about, right? So just analyze what they're saying. So the simple reason forecasters don't expect much from the U.S. stock market over the next decade is that stock prices are already very high. Well, I have a quick comment here as well. So very high compared to what? Compared to yesterday's price or to the decade's price, or you're comparing to possible future prices or projections that you're making, right? So this is, I don't know. It really depends. It really depends. Just to say that prices are very high, it depends. There's, I will show you guys on the charts. There's so many moments where people thought, well, prices are already very high, just to see the price go even higher. Okay, so that's why I don't like valuation very much for um, stock investing, right? Because of that, it's easy to make a mistake. To If you make a mistake here, your conclusion is going to be wrong, and then you're going to make the wrong decision. Okay, so stock indexes have been breaking records. Sure, they have. To analysts, that means many stocks are overpriced. Bargains are fewer. The indexes have less room to grow. Well, this is true or not? I don't know. That really depends on what the analyst is thinking. Another mentality that I've seen so much, in all my years, in professional trading rooms, I met all kinds of traders, and you know that you can imagine. And a lot of them believe, and I think that's wrong belief, that there is some kind of mean reversion in stock prices. Okay, for stock prices, there's some kind of mean reversion. Like if the prices go up by a lot compared to that imaginary mean, the I say imaginary because there is not a mean, but I'm going to show you graphically because then you're going to see it easily. Because they think that if prices go up very much against, say, an average or historical mean, the market has to come down because there is a force that is going to pull it back to the mean, something like that. And the same goes when the market goes down by a lot. They have to revert back to that mean or something like that. There are a lot of people who believe that, but the reality is that asset prices, there's no such thing as a reversion to the mean. There's a lot of things measure, metrics that revert to the mean. For example, volatility is a kind of thing that it's it, it reverts to the mean most of the time. Yeah, it reverts to the mean. Okay, but not stock prices or any asset prices or house prices. There's no such thing. Okay, just how overpriced is the stock market, right? Economists have a yardstick to measure that. It's called the cyclically adjusted price to earnings ratio, or CAPE ratio. It measures a stock's price against corporate earnings. It tells you, in effect, whether the stock's overvalued or undervalued. Okay, so here the yardstick for comparison is corporate earnings, right? But even there, um, especially for growth stocks, there's a lot of room for because it's like, it's it are these earnings forward looking, or uh, you know looking back, or it's current earnings, or what is in the books. It changes. It's not exactly the same, right? So let's keep looking here. So right now, the CAPE ratio for the S&P 500 stands at 38.7. That means stock prices are very expensive relative to earnings. So let's take a look here. This they're comparing to history. Okay, so this is the Schiller CAPE, which is exactly the CAPE um, ratio. And if you can look here, this first peak was in the 1930s, right? The 1929 crash, and this other peak here is in the early 2000s, the dot-com crash, right? And we're here, 3809. We're moving in that direction, but we're not there yet, and we're higher than this one, and we didn't really crash. Um, so it still keep going up. Okay, so this one, imagine you are here, right? This day here, you are here in this day. This was like early, maybe 1999 or something. And you look at this and say, hey, look, we already achieved this level here, right? But it kept going up, right? So anyway, of course, at some point it crashed down. Okay. And another indicator that people use a lot is the Buffett indicator, which measures the stock market value, the market capitalization compared to the GDP, right? So buffer indicator is the US total US stock market value divided by the US GDP, right? So this was in March. We got 59 trillion divided by 29 trillion is 200%. And if you look at the history here, is also suggesting that we are very, very overpriced. Okay, like two standard deviation high. Okay, right here. Okay, so if you are the kind of person who thinks that it has to revert to this mean, this is this historical trend line, we are overvalued. All right, so stocks are gonna come down. So these studies, this one and this one, make those analysts believe that the next decade is going to be horrible, right? Because we're already very overvalued and it will come down. So that's the pretty much their conclusion based on these studies. But let's take a look at here, right? So this is 100 years of the S&P 500. Okay, so look at this. It's exponential growth, right? Of course, they had like great crashes here and there happened a few times along the way, but if you just look in general, it was a very bull market, right? If I ask you what's the historical mean the market's reverting to, is there any mean reversion here? I don't see any mean reversion, right? It goes up unless it's, of course, the mean is growing. Mean is also growing. All right, so that's the thing. At some point you think, wow, really, this point is high. Yeah, it's very high. You had to correct. Yes, it did correct, but then it turned around and keep going. All right. Okay, now this chart here will give you a better view of this, because this the y-axis here is a log. Okay, is a logarithmic scale. So you can see like pretty much a f- a f- uh, a straight line. All right, because from this to this is 10 to 100, 100 to 1,000, from 1,000 to 10,000. All right, that is just this flattened with the log axis. All right, you can see it. So if we look at this, right, so the um, scale, logarithmic scale, right? 150 years history from 1871 to 2021, right? What happened during that period, right? So we had a World War II, especially after World War II, the market really started taking off, which makes sense because the United States was the biggest winner of World War II. The dollar became the world reserve currency, right? So there's really the U.S. global hegemony since then. Then we had those golden years, right, until the 70s. Um, but for the country is has been a great run, right? Most innovation technology was created here in the US, so the US stock market growth actually is accelerating. It's not a straight line here because it's a logarithmic axis. In reality, this in US dollars, it should be this, right? It's moving like this, right? We're just flattened for easier visualization, but actually it's accelerating. Okay. All right. But the great question is, okay, During this time, the United States didn't really have much competition from other countries, right? Because, economically, technologically, Japan got close, Germany got close, right? But the US just went ahead of, those those countries. They didn't have a big market that like the US, right? They didn't have it. But now we have China, right? China is also competing in AI and quantum computing and all the future. They already listed what are their strategic areas they want to compete with the United States. So we're going to have more competition. With competition, will this growth keep accelerating at the same pace that it has in the past? It's something for us to think about, right? We don't know the future. We can't, we're not practicing futurology. We don't know what's going to happen. But, you know, that's why I'm making the case for using risk management as your guide. Okay. If the risk management is going to help you navigate this, you don't know what's going to happen. If the US is going to, you know, go past China, just like did with Japan and Germany, maybe yes, maybe no, maybe so, maybe somewhere right in the middle. We don't know, right? We don't know. So one thing I think is for sure. I don't know if the next decade is going to be a great decade or a horrible decade. I don't think so. I think it's probably going to be somewhere in the middle. But one thing I think is going to happen is that we are going to have more volatility. I think risks are going up. All right. We're going to have more volatility. All right. Because you have more competition. Geopolitics is also shaping the world. We're in the transition period. The BRICS countries accelerating past the G7. So there's a lot of things happening. There's tectonic shifts happening in the world. And that is important. We need to use risk management as a guide. All right. Just like you're in a dark room, you don't know what's going to happen. You can't see anything. You can't see much farther, but you need to use some tool to guide you every step of the way. All right. Okay. So let's keep going. So it's a gloomy forecast for 2025 and for 2035, right? That's what they say. It involves complicating factors. Stock market forecasts are also surprisingly conservative for 2035. Vanguard. Okay, so here we're talking about Vanguard. Let's focus on this. Vanguard, the investment firm, predicts U.S. stock market as a whole will rise by an underwhelming 3.8% to 5.8% a year over the next 10 years. Growth stocks like the likes of Nvidia and Amazon are projected to rise by only 2.5% to 4.5%, not much faster than inflation. Wow. Okay. Wow. Not very excited, huh? Okay, those forecasts are based on the idea that many US stocks are overpriced. It's the same idea, right? And trading above their real value, right? The real value. What's real value, right? Real value. Compared to what again, right? Compared to what? Okay. In Vanguard's analysis, everyday investors who want to gaudy returns, they have come to expect from American growth stocks would do well to look elsewhere. Global stocks, small cap American stocks in companies with lower market value stocks trading below their intrinsic worth. So this is the suggestion that they're making for investors. All right. We're going to take a look at each of those if they make sense or not, right? And you judge by yourself. Okay. I would say it's time to have a more balanced allocation. Well, it doesn't mean anything to me. Okay. So what do you do about the gloomy stock forecast, right? So if you want to avoid market concentration and overpriced stocks, forecasters say, here are some places to look. So one is value stocks. Okay, value stocks. Vanguard value stocks to rise by 5.8 to 7.8% a year over the next decade. Well, compared to what they're projecting for the S&P 500, 5.8 to 7.8 a year look better, right? But is that great? The S&P 500, used to return 10% a year on average, right? 5.8 to 7.8 to me sounds like a little bit of a downgrade. And especially for people that, you know, need to accelerate their wealth, those kind of returns, I don't know. For some people may be enough, but for many people, I don't think so. All right. Okay, so let's take a look at the other suggestion that they're giving us here. Okay, so small cap stocks. One way to skirt the Magnificent Seven is to invest in small cap stocks, which are shares in smaller companies. Vanguard predicts small cap stocks will rise 5 to 7% annually over the next 10 years. Almost the same, right? Didn't really change much from value stocks. Almost the same, I guess. And this one here, I see a lot of people talk about this. Non US stocks. Some analysts consider foreign stocks a better deal than US stocks because they have not seen the same level of froth and growth. Morningstar projects non US stocks in developed markets will rise 8.1% annually over the next 10 years. Okay, let's just focus on something they said here. Developed markets, right? Which are the developed markets besides the US? Maybe Canada, uh, Europe, European countries, Australia. Well, let's focus on Europe, right? Europe I think it's the largest with several countries in there. And we just saw the trade deal that Trump was able to make with the Europeans, right? Well, I don't know what you thought about that deal, but I think that deal was horrible for Europe. It was great for the US, right? So I don't know. They're gonna, one thing that it's very important is energy. Europe depends on energy from somewhere else. They need energy imports because energy is the input, just like any other commodities and materials that will make an economy grow, right? To grow an economy, you need energy. That's the basics, right? That's the basics. And they're not buying energy from Russia, which is cheaper. They're buying more expensive energy. So that would not give them a competitive advantage, right? Especially versus the US. So I don't see Europe really outperforming the US. I'm not so sure. If anything can happen, of course. Again, I'm not a futurologist. So I don't do that kind of thing. I don't try to make projections, but you know, just the logic of it, I don't think so, right? How about emerging markets? I think emerging markets have a better chance than developed markets, the rest of the G7. I think in my opinion, I think the G7, the US is still going to dominate the G7. But anyway, so I don't want to uh, make predictions here, but it's from the current situation, just by looking at it, that's how I think. But let's take a look at all three. All right, in a more let's take a look what we got here. So this the first one here. This is the S&P 500 versus the Russell 2000 annual returns from since 2000. All right, since year 2000. So the blue line is the S&P 500, and the brown line is the Russell 2000. As you can see, they move pretty much in tandem to each other, right? So the S&P 500 is dominated by the Magnificent Seven, right? The large, good, the blue chips, the large cap, and Russell 2000, smaller companies, right? They're telling us to invest in smaller companies. I don't see much of a difference, to be honest. Of course, there is some differences, but they pretty much move in tandem. So I don't know, by moving away from the S&P 500 to the Russell 2000, it's gonna make such a difference, right? Because if you look at the large caps, especially the Mag 7, they're responsible for most of the returns that the S&P 500s are is delivering. Okay, all right, and this is those are growth rates, but here we're looking at prices, right? And as you can see, even though they move in tandem, et cetera, you can see that growth is outpacing value by a lot, right? So what they're saying is probably this is too high and it's going to come down, but I'm not so sure if this is going to meet the the, the blue line some point in the future, right? So basically what they're saying is, okay, this gap is so high, this is so overvalued here, they're going to come down. So for you to switch from the blue line to the brown line, they have to meet at some point, right? That's what you want, right? I just don't see it. But anyway, um, so what about value stocks, right? Oh yeah, move away from growth stocks and let's do value stocks. Um, it's almost moving in tandem. Of course, there's the blue line is more volatile as expected, right? And in terms of, here is the growth over value index ratio, right? Basically a ratio, right? Ratio. It's really like, you know, very um, lean towards the with growth stocks. That's what we're seeing here, right? So what these people are expecting is that this line will come down. That's what they expect. So just like, if you're trading any stocks or investing any stocks, I don't see an inflection point. I haven't seen yet. Right? I have to see at least an inflection point, and 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 this line turning around. Then I think, well, maybe there's a chance. I don't see it yet, or maybe they will. Okay, so here now we already talked about the the first the value stocks, the small caps. Now we're going to the international stocks, okay, versus the U.S. Okay, so here, what is this chart here, right? So this is the MSCI USA index versus the MSCI World Index, right? So the correlation between them indicates that US stocks have historically outperformed global stocks, right? It's always up above one, right? Okay. Specifically, the ratio of the MSCI uh, USA index to the MSCI world index can rise, suggesting that US stocks are outperforming the global market. Conversely, a decline in the ratio indicates underperformance of US stocks compared to global market. Okay. Over the long run, the correlation between them has also shown a trend of increasing correlation, increasing. Okay, reflecting a shift in investor expectations and market dynamics. This means that while US stocks have historically performed well globally, the correlation has evolved, indicating a potential for diversification benefits when investing in international markets. It's good for diversification, right? Of course. But again, look at what it says here, increasing correlation. Right. Because the US is not an island in the middle of nowhere. The US economy is well integrated with the rest of the world, right? All markets are integrated. So they tend to move together most of the time. Of course, there will be times they will move in opposite directions, or that's correlation, right? Correlation has been increasing. So you're moving from US to international, are you going to do much better? I'm not so sure. Okay, I'm doubting that as well, right? Okay, well, okay. So one important thing to notice is this chart here, right? So this is pie chart. The U.S. is huge, right? Almost 70% of the world of stocks is American. Oh my goodness, they're huge, right? Okay, here this chart here, US stocks have outpaced non US stocks between 2008 and 2022. That's true. The blue line compared to the rest of the world, right? The orange line, right? And if you look at the sharp ratios, right? Sharp ratios, return risk ratio, right? Look at this. You know, the better the the higher the Sharpe ratio, the better, right? So let's take a look here. 17.15%, according to this study by the U, University of California, San Diego. Okay, U.S. exposure 80%, and non-U.S. exposure 20%. At 80-20, with more U.S. exposure, you have a better Sharpe ratio. That's what this is telling you, right? But here, but not always, right? If you have 70-30, you have a 17.11. But if you have 90% of US exposure, that's too exposed to the US, and then you get a worse Sharpe ratio. It seems like the the better combination, if you're gonna add some non-US stocks, would be here, 80-20, right? Seems like this proportion is kind of optimal from their study. All right, from this study here. How on earth do you allocate effectively when US market has grown so large? Right? Okay. All right, that's a problem. All right. Okay, so what to do, right? Let's just recap, right? I think the most important thing is to be strategic, thinking long term, and be tactical with risk management. That's the best way to, to solve the problem of if it happens, right? Because we don't know, right? Are those projections going to materialize? Going to be a horrible in the future? We don't know, right? And who knows, right? We don't know. Nobody has a crystal ball to know for sure, right? But the best thing you can do is to be tactical with risk management. Okay, so again, just a quick recap here. All right, how we made it. We made it with tactical risk management by rotating assets according to risk, to the risk regime. You can a high risk scenario and a low risk scenario. It calls for a different kind of asset, right? Just like the bad pavement, pavement, and urban quality pavement, you're gonna you can accelerate here, and here you gotta go slow, and here you can go normal speed, right? So you have to adjust yourself. Get, you're in the market, you're not looking at anything, you're just like closing your eyes, not seeing anything, just move at constant speed. That's the buy and hold guy, right? Buy and hold investor is just ignoring whatever is going on, ignoring the uh, the quality of the roads, right? You're not even seeing anything, right? Not a good thing to do. Not a good thing to do. All right. So again, the analogy here I explained before. Just a quick recap. All right. And strategy 6, we really, you know, we take advantage of that idea to implement it in the markets. All right. So it's naturally we're gonna get much better results. All right. So where's the proof? I post every day this. All right, on social media, on Facebook and X. Why? Because I can prove that what I did. So here you can see the time, the date and time stamp, right? It's proof that I posted that day and that time. After the market is closed, I'm gonna post it and say, well, you know what I did? I held, uh, for strategy 1 to 8, right? What I did, right? If I bought or held or sold, right? And the The year to date return is updated once a day with these numbers. Okay, so it's very transparent. Results are posted every single day. It's, it's total transparency. All right, you can check it by yourself. Not have nothing to hide. All right, today I just posted. Um, I haven't posted it yet. Good, yeah, good point. I haven't posted it yet. After this, I'm gonna go ahead and post it. All right. Okay. So just a quick disclaimer: this video, this is, we're, what we're doing is our personal views and general information, education purposes only. It's not financial investment advice. Okay. All right. And if you're not in our club yet, I invite you to join us. Right. As a club member, you'll get the special access to the risk 500 indicator. Right. You can use it to time the market, to detect and avoid market crashes early, beat the S&P 500 every year, and truly accelerate your wealth. Okay. And you have other benefits here. You can read later. All right. And it's gonna help you achieve your goals. That's pretty much it. All right, with less risk and more return. That's what we want, right? I just find like sometimes we're talking to advisors, and most advisors, they don't talk about risk and return, right? They just tell you about return. They're gonna tell you, well, I think you should invest in stocks A, B, and C. I'm gonna propose this portfolio for you. And the expected return is this, and that, but nobody talks about the risk. And they can talk about the risk, but they don't quantify it for you, right? They don't quantify it for you. Like, what's the probability? Say, for example, asset A, right? They're going to put in your portfolio an asset A and asset B, asset C. They'll say, wow, the expected return for asset A is, I don't know, like 20%, B is 15%, C is 13%, right? But what's the probability of it achieving that kind of return? It's a high probability, it's average, or it's small, or what's the risk involved? What's the expected volatility around that number? Nobody talks about that, right? I I, I never heard. Anyway, okay, but here we are very technical, where we go uh, by the numbers. We do risk management, so the risk number is going to guide us through the way where we don't need to make any kind of a projection or forecast of what's going to happen. If the market turns out to be horrible as those forecasters are predicting, fine, right? We're still going to make money, right? So that's the most important thing. We want to make something that's very uncertain with some certainty and control. We want to be in control, right? If you're buying a whole investor, you have zero control basically. Okay. All right. So here's I exceeded my time a bit. So yeah, because we got a lot of material. We didn't even talk about the market today, right? But I knew there was a lot of things to talk about. But yeah, I hope to see you next Wednesday. All right, mark your calendars, and you have a great week. All right. Thank you so much. Take care now. Bye bye.